Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Market.Fi. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Jack Litle on the line. He's the CEO of Mercenary Trader, 17 plus years of experience in the markets. Jack, how you doing this morning?
Great. How are you guys?
We're doing good. Thanks for coming
Good.
on. So I know I asked you about this last time, but for our new listeners, Mercenary Trader, how'd you come up with that name?
Sure. Well, the idea is to be loyal to your friends, not your positions. And you have to have a certain sort of ruthless objectivity to do well in markets. And traders and investors alike benefit from that. And so our name sort of reflects that a little bit.
Yeah, and that couldn't be truer here in these markets. So, we've had a nice rally, really nice 2 day rally to put it. And, it kind of overshadows some of the things that are going on in the market. And we still have some risk in China and more commodity fallout in China. What's your comments on that?
Sure. Well, I think the rally that we just had is based on hope that it's sort of this permanent zero hope that the Fed's basically never going to be able to raise interest rates because jobs are too weak. And also there was a lot of relief, I think, from the Glencore situation last week. Briefly, people thought Glencore, this giant commodity player, was going to be another Lehman Brothers, and everybody got really scared, and then they realized, actually, no, they're probably going to be okay. But I think what people don't realize is that there is potentially another really big shoe to drop in China, and that China's black box economy could have another 10 Glencores hidden inside it. When you look at the numbers on the debt and the leverage from Chinese commodity producers inside the Chinese economy, it's really, really frightening. So we can't be certain that China's not going to drop another really big ugly shoe on markets. In fact, it's probably more a likelihood than not, which is a big concern underneath the surface here.
Okay, all right. Definitely keeping an eye, and I guess that would kind of go into some of the Chinese stocks that trade over here as well. You've used the term about this nearly 100-point rally in the S&P since Friday morning as a suckers rally. Give us your thoughts on that.
Sure. Well, I think I'm very skeptical of this rally, this surge. I think it could continue for a little bit of time, but basically the fact that this rally is occurring because the jobs report on Friday was so weak and because people are hoping that the Fed just simply will not raise interest rates, that's a bad reason for markets to still be going up. It's sort of hoping, hey, we've had all this stimulus juice over the years. Let's hope that some more is left. Really, what you're hoping for when you hope for that is you're hoping that things are going to stay really weak and negative, and the U.S. economy is going to sort of soften up along with the global economy, which is kind of turning down. And if that's how things play out, then corporate earnings and profit margins are going to contract. And so it's really not a very exciting reason to be bullish. And David Tepper, probably the most famous bull of the past 5 or 6 years, he came out on CNBC a little while ago and basically said, hey, if we get too excited because the Fed's not doing anything, I may even think about going short. So just not really great reasoning to be excited about buying stocks again because the Fed's not going to be able to raise rates because the economy looks so bad. That's just a sketchy reason to be long and more possible reason why this thing could fade out or sort of be a bull trap.
Well explained. Our earlier guest at the 8:35 slot, Nick Shaheen, called them, relief pops. There hasn't been any real change in the fundamental data. People are just relieved that interest rates aren't going up, and you just alluded to that as well. Earnings season coming up here. That could be a little bit of a catalyst here, maybe to get us back to that old support level in the S&Ps, which held for so many months at the 2040 level. What are you looking at for earnings season, which kicks off on Thursday with Alcoa?
Sure. I think in earnings season in general, it's going to be more important what the overall feel is for corporate profits. People are really starting to be worried that corporate profit margins are not going to hold up. We've seen corporate profit margins in general start to get pressure basically from the energy sector. I mean, energy companies have just been trashed. But the real question is, if everybody remembers, we've had these historically never before seen incredibly fat corporate profit margins that have persisted for a long time now. And if there are signs that those margins are starting to contract, then that's going to make everybody really, really nervous, because contracting corporate profit margins are not good for stocks, and they're also potential harbingers of recession. And the other question on everybody's mind with corporate earnings is, have these really good earnings really been a prospect of businesses doing well, or are they the result of financial engineering? I mean, one of the ways you juice up your corporate your earnings is by buying back shares with borrowed money and doing all this other funky stuff that these guys have been doing. So I think it's really sort of a nervous canary in the coal mine, watching these earnings to see if decent numbers still roll in. And if they do roll in, then things will be okay. But if they start to get shaky, that's another reason why this could turn out to be a little bit of a sucker's rally. So I think there's some nervousness around how those numbers are going to look.
Always looking for leaders and laggards in the market. You had different sectors, all participate. Technology that took us up to all-time highs. One sector that was a big factor was the biotech sector. And now, boy, oh boy, if you're looking at the chart and you're looking at the relative strength of these biotech stocks here, they're telling you that this may not be the healthiest market.
Right. Well, there's two big problems with biotechs, at least. The first problem is that biotechs are seen sort of as a canary in the coal mine bellwether for speculative appetite in general. So if biotechs continue to see price deterioration, that is sort of a bad signal for risk-taking overall, and that's going to make a lot of traders nervous. The second big problem with biotech is all of a sudden you have this explosion of political risk in biotech that was sort of kicked off by that kid Martin Shkreli raising drug prices, and then Hillary Clinton came in, and then the whole Democratic structure went after Valiant Pharmaceuticals, and that whacked a whole bunch of high-profile hedge funds. And now there's this general sense of, wait a minute, the whole pharma industry model is based on jacking up prices. And so if biotech becomes this big political football where they just get, the pharma model gets attacked by Washington, then that could just suck all of the positive sentiment out of the market, and then you're back to the first problem of traders are going, oh no, one of the hottest speculative areas of the market is bearish now. Maybe we should turtle up.
Yeah, okay. These things are volatile, and you're right. Martin Shkreli got it kicked off. These stocks are just, they had their run. And the other thing you look at is, well, let's say they do rally, and do they get some upgrades, a good drug test? There's going to be a lot of offers out there. People
Right.
are looking, and also you have, even if you take a stock like Biogen here, let's take a look at that. Where it's come in the last 5-6 years. There's still people sitting on some huge profits. Yeah, they wish they might have, sold it, above 400 here. But if you're long from anywhere from under, $100 back in the financial crisis, you're still sitting on some nice profits, and you don't know where they're going to exit on weakness. In fact, this is looking really weak this morning. Looking at well below the flash crash low here, or
Right.
actually just at it. Something to keep an eye on here. Just stealth dollar that could have an effect on earnings. We kind of already covered that. Is there anything you'd like to add on the dollar index not showing the true picture?
Sure. Well, the interesting thing about the dollar is people don't realize the damage that the dollar is doing behind the scenes. I've sort of compared the dollar to termites eating away at the foundation of a house. The Dixie, the dollar index, which people follow widely, it doesn't look that bad right now because it's something like 40% composed of the euro. But if you look at the dollar against emerging market currencies, it's kind of been Godzilla, and the dollar is also a creeping danger factor in harming corporate earnings because something like nearly 50% of S&P 500 corporate earnings come from overseas. So the dollar is just a big pressure factor, but because it hasn't been raging lately, except against emerging market currencies, people aren't really paying attention to it. But that's probably one of the hidden negative reasons why corporate earnings are starting to soften and look a little dangerous here.
Okay. All right. So if there's worries in the market, right, concern, then you got to be looking to the gold and silver market, right?
I would not look to the gold and
Yeah.
silver market right now, and not for a while. I think that the gold and silver market really is driven by a hope that inflation is going to come back. I think that's the main thing. You have these people just waiting for this outbreak of inflation, and the central banks losing control because they can't raise interest rates because the economy is too weak with inflation raging. And I think that will happen at some point. At some point, we look forward to backing up the truck on gold and silver and gold stocks, but it just still feels way too early. I mean, when you look around, the market's not really worried about that. And the other problem with gold and silver at this point is they have the same risk asset sensitivity almost as like biotechs and other stuff. So if the market has a big sell-off, they're going to get whacked with everything else. So my opinion is that the time for gold and silver will come again. It just still might not be for a while yet.
Okay, I was being a little facetious on that, Jack.
Sure.
Okay, I don't want to give you a hard time here. Uh, why oil stocks look so bearish here? And real reaction to Russia or the Middle East pot stirring? I've been looking at this gold chart, Jack, and I'm just itching to buy a strangle or something like, 50 or 40. To me, it just has to move out of here. When's the last time you've seen over a month of consolidation in here in the crude oil market? Now, if you're going strict from a technical basis here, you've had a prolonged downtrend. A
Right.
consolidation should be resolved to the downside, but why? Oh, man. Talk me out of wasting some money on like a 50-40 strangle on this one.
Sure. No. Well, I actually I think that could be an interesting idea. I mean, if you're looking for a volatility expansion from this tighter coil, oil is just it's a very sort of contentious battleground right now because you have a lot of money managers who think, oh well, prices can't stay down here; they have to go back up. But at the same time, the fundamentals still just remain very bearish. I think oil is similar to gold and silver in that it's sort of a conviction story for a good chunk of bulls, which is why we saw that huge rally off the lows over the course of just 2 or 3 days before the consolidation started. But there's still just a whole lot of incredible heaviness weighing on it. I mean, the fundamentals for oil in terms of supply coming out the yin-yang are still terrible, which is why you can have hedge fund managers like Kyle Bass making a credible case that oil's going back to 60, and then Goldman saying that oil's going to 20. So, and then it also depends on what China does and emerging markets do. If we get another big shoe dropping out of China and another wave of deflationary fear, then oil's probably heading back down to $20. If I had to pick a direction, I would pick bearish, just because I think there's a lot of bullish managers who tried to be smart guys and are buying oil for the rebound here, and they may get negatively surprised. I'm also a little bit surprised that oil hasn't done more with all the pot stirring going on between Putin and Syria and Saudi Arabia stepping up little mini war games with Iran and things like that. Oil hasn't done anything in the face of all that, which is kind of a bearish sign.
Yeah, definitely. We'd expect it to get a pop off that. Moving in, technology sector, we had all these IPOs. Brent, who I work with, was, seemed like every week he was popping in IPOs, all these different things going on, and that's kind of been quiet lately here. Signs of a unicorn markdown showing potential Silicon Valley peak. Dropbox, I believe the symbol box, BOX here, is not a pretty looking chart, and you're also making an Evernote, etc. What are you
Right.
talking about there?
Sure. Well, Box is one of the companies that went public, and they're actually publicly traded, and they were sort of a disappointment even from the time they went public. Dropbox is still private. They're one of the sort of super unicorns. Dropbox was privately valued at something like $10 billion about a year ago, but just recently, some of the big mutual funds that have private stakes in Dropbox wrote down their holdings by something like 20%. So there's no official publicly traded market for Dropbox yet, but some big guys, I think it was maybe Fidelity and someone else, who have purchased stakes in this private market, they said, well, we're writing down the value of these investments. And so people are starting to think, we have to question these pie in the sky valuations relative to what we're going to get for cash flow. Evernote was one of sort of the original unicorns. They had a multi-billion valuation. I believe it was a couple years ago, and there was just a lot of buzz around them. And now there's a lot of disappointment and pessimism because their execution has been so bad. They just bungled a lot of things and had a lot of buggy feature releases and haven't monetized as quick as they can. And then there was another company, I forget the name offhand, that they were a unicorn, but then they sold for cash at something like half their peak unicorn valuation. So what's happening in terms of sentiment with these unicorns is when you get this transition from the sort of pie in the sky best case scenario valuation to what they actually sell for when cash changes hands or when people sober up, it's sort of like waking up with a hangover after a really good party. And that sort of markdown process is another big shifting of gears in sentiment that could, at some point people are going to wake up and go, wow, this was, a great game. I need to take my cash off the table. I need to pull back. So we're sort of seeing that. We're seeing that big shift in action now, which could trickle over to sentiment for more publicly traded tech names.
Jack, before I let you go, I mean, I've thrown everything at you, the dollar, gold, silver, oil, stocks, earnings. Where do you get your info? I know you do a lot of hard work. I know you work on technicals and stuff. Where do you get your information? You just read a little bit of everything, the Barron's, the Wall Street Journal. You really cover everything. I was just curious.
That's a good question. We have really worked on that process over a lot of years. We have we have information sources that probably span the equivalent of 10 or 15 newspapers and publications every day, plus all the price data. Plus, we have a really great network in our community of independent traders and hedge fund managers at some of the largest, most well-known hedge funds in the world. And so we just sort of have a network. We have a lot of communication among our guys, throwing ideas back and forth, and we do a whole lot of homework. So, macro is our game, and so we kind of try to pay attention to everything and then put all the pieces together.
Yeah, no, great information and definitely getting an education, talking to you and learning about the markets. I really appreciate you taking the time out and coming on, and would certainly like to have you on again soon.
Always love being on. Thanks for having
And,
me.
and I'll follow you on Twitter right now.
Awesome. Sounds good.
Okay, thanks, Jack.